So let's have a sesh on the fiscal and monetary policy contribution to the 2020 Covid-19 recession. In this video, I particularly want to look at the fact they had clearly coordinated and worked in tandem to alleviate the extent of course, the recession. The first example I want to look at is the 11th of March. And the 11th of March was a couple of days after Black Monday. And Black Monday was when, of course, the FTSE 100 lost a lot of its value, and it was the same day that we saw oil prices had fallen because of a price war between OPEC, particularly Saudi Arabia, and Russia. Now, before markets opened on the 11th of March, we had a monetary policy response, and the monetary policy response was twofold. The headline, I suppose, was the fact that interest rates had fallen by 50 basis points from 0.75% to 0.25%, clearly a form of expansionary monetary policy. Additionally, there was the introduction of the TFSME with additional incentives, so term funding for small and medium enterprises with additional incentives. And those additional incentives into the fact that essentially funding had been provided on a term of 4 years to small and medium enterprises. Well, the additional incentives was the fact that it was close to or just about bank rates or base rates. And that was in excess of 100 billion they were willing to offer to essentially provide liquidity to firms so they could see their way through. Okay, so additionally, that was the monetary policy response, but we saw that day, because it was the spring budget, and we saw a fiscal response. And the fiscal response came in the form of 20 billion in grants to small and medium enterprises. Remember, grants are not going to be repaid. And we saw 330 billion offered in government-backed loans. Loans, of course, need to be repaid. But that's a huge response. And again, it's clearly a type of expansionary, but this time fiscal policy. So we're seeing expansionary fiscal policy and expansionary monetary policy clearly working in tandem there. And just to put in context that fiscal response, the previous fiscal deficit was around about 31 bill. So clearly a big response. Now, the second follow-up fiscal and monetary contribution is a little bit more technical. So we'll start with the initial side that came from the monetary side on the 19th of March. And there we saw a further drop in interest rates from 0.25% to 0.1%, nearly getting to that point of 0%. But perhaps that was the smokescreen for the big one, which was the fact that QE had been extended by 200 billion. Taking the total responses to 645 billion. Now, working through what more QE means. More QE means there's an increase in demand for government bonds. If there's an increase in demand for government bonds, clearly the price of government bonds or gilts will increase because of the increase in demand. And of course, price and yield work inversely. So therefore, the yield had fallen, which meant if the yield was falling on government bonds, then the effective cost of borrowing for government debt has fallen. Okay, so that provided some space for the next response the next day from the fiscal side, and that was when we had the introduction of the wage subsidy, formerly called the job retention scheme, where 80% of salaries up to $2,500 per month were going to be provided to ensure that firms were able to keep their staff employed. That was the main criteria that firms had to adhere to get this subsidy. And it was estimated that at best this would cost 9 billion, but possibly a lot more. But the key is we've again had some more expansionary fiscal policy, and we've had some expansionary monetary policy here. But clearly the expansionary fiscal policy would mean the issuance of more gilts, and more gilts. Well, the good thing about this is the fact that space had been given by the Bank of England because they had pushed down the yield through more QE, so making the financing of this national debt or of these gilts slightly cheaper than it otherwise would have been. So some good fiscal and monetary contribution working together in tandem. I hope that helps, and I'll see you at the next session.